We'll get started momentarily. My name is Darryl Brown. I'm a portfolio manager at Genus Capital Management.
And I'm James Dick, Senior Sustainable Investment Associate at Genus. Great to have everyone here.
Today, James and I will be hosting the session where we'll provide some context and insights around the field of alternative investing. It's an exciting area. It continues to grow very quickly within the wealth management industry and with our clients' interest at Genus. I think of note, it's really fun to be here at this time as we continue to innovate at Genus. And so today we're going to talk about alternatives, the case for alternatives, and how alternatives can meet the world of impact investing. We'll have a few wrap-up thoughts, and of course, there will be time to answer questions. While we're waiting for more people to join, a few housekeeping items. Number one, I think it makes sense to maximize your screen for the best viewing experience. Two, if you'd like, you can type in questions at any time in the chat. We'll spend most of our time together going through the presentation, but also taking some moments to answer any questions where we can. Three, if you have any technical trouble, you can let us know through the chat and we can have someone on hand to try and assist. One great solution we found is to hop off, then come back on into the room if you're having any audio or video problems. I'd like to start by recognizing the lands that I'm on. They're the traditional territories of many First Nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat people, along with a number of other First Nations, Inuit, and Métis people.
Great. And I'm calling in from Calgary and would like to acknowledge the land and pay tribute to the traditional territories of the Treaty 7 people, which include the Blackfoot Confederacy, comprised of the Siksika, the Kainai, and the Kainai First Nations, the Tsuut'ina First Nations, and the Stoney Nakoda, including the Chiniki, Bearspaw, and Goodstoney First Nations.
Okay, to give some context about where we are as a firm and what we're talking about with our clients, it's really exciting to have a chart like this, which I think everyone at Genus is proud of. Our clients are really excited to know exists, and that's the breadth and scope of the investment solutions we provide for our clients. They range across the ESG and value spectrum. We include ESG factoring in our funds, all of our funds, and then we go right up to having screens in our fossil fuel funds, and we have impact-oriented solutions, including our Impact Investment Council, which we'll talk about a little bit later. It's a really unique investment product offering, I think. Reasonably across the entire Canadian wealth management space, I can't think of another firm that provides households, individuals, foundations with such a wide range of investment solutions. So if you can't tell, I'm really excited about it. I think everyone and the Genus team is really excited about it. I'll note we recently had a successful launch of our commodities fund, which is one type of alternative investment product, just one of hopefully a few that we will roll out over the next few years. And that fund is designed to provide our clients with additional inflation protection, exposure to transition materials as we move towards a lower carbon economy, and provide an additional tool for our clients to meet their investing goals. So we've got a poll for you to start, and that is, how familiar are you with alternative investments? If you haven't quite heard the term before, most people regard alternative investments as anything other than stocks or bonds. Some people might have interest or knowledge in alternatives. You may not have heard of them, and we'll take a few moments to see what the answers are. There are a number of different types of alternative investments out there. For me, I would say cryptocurrencies probably jump top to mind as a type of alternative. Private equity, private debt, those are the ones top of mind for me. James, what about you? When you think about or talking about alternative investments with friends or family, what are some of the different types?
Mm-hmm. Yeah, I think with the work I get to do in the Impact Investment Council at Genus, a lot of the time it's venture capital discussions. So fitting in that private equity realm, a lots of cryptocurrency discussion throughout the years, and even more recently, I was chatting to my mom this morning about cryptocurrency, and kind of a wide variety there, but also infrastructure and real estate. Seems to be more and more discussions about that related to affordable housing and those kinds of investments there. So.
Yep. Yeah, I would say largely we'll definitely go into a few more for the audience, a few more areas of the alternative investing landscape. But so far, like that's just a straight bell curve right there. Very, yeah, half of everyone right in the middle, and then very nice shoulders there. So okay, we've got a very widespread audience. So types of alternatives, like I mentioned, there's a range out there. Private debt, so loans to companies that are not publicly traded. Ownership, that's private equity. Real estate, so our current existing client base might be familiar with our commercial mortgage fund type of alternative investment out there. So we're already have a number of a couple of different fund options which fit into under this alternative umbrella. But overall, as an industry, you can include hedge funds in there, infrastructure, like James mentioned, structured notes, which are financially engineered products, combining a number of different asset classes. Natural resources, which is where our commodity fund hangs out. And then everyone's favorite, cryptocurrencies, which would fall under digital assets. And yeah, there are a good number of alternative investment options out there. And so looking at the case for alternatives, why now? What's happening? If people are, have started to see alternative investments pop up in discussion on their phones, what is going on and why? Well, there are a number of different reasons. So firstly, the time that we're at right now when it comes to financial economic news, the variability, the volatility that we're seeing, it is now changing. And so we're seeing there's a lot more variability in the news cycle and the evolution of the financial markets, and how that impacts our ability to manage client portfolios means that it is helpful for us to have additional tools and additional options for our clients that we can utilize in which fit their investment objectives from a values and sustainability standpoint. Traditionally, investment managers, they manage portfolios by managing the portion that's in equities or stocks versus the portion that is in more stable fixed income investments. Alternative investments have a role in there because they're neither. And so they provide a great way to have a financial return for clients and have a lower correlation. And so we'll take a look at that on the next slide. Inflation pressures, we're not at the same 6 or 7% inflation prints we saw coming out of COVID in 2022. Inflation has settled back down, but when we're looking at the investment landscape and where inflation ultimately settles relative to the previous several decades, what do we think it might be going forward? Where will it settle out? Having an additional investment option as an alternative investment in client portfolios will help us both meet our clients' investment objectives, irrespective of the inflation environment. So that's going to be really important as we look forward. Thirdly, the wider dispersion and reorganizing of capital flows. Points 3 and 4 are somewhat related. And so when we think about the overall economy, the financial prosperity of companies, their growth, companies are staying private longer and longer. They are utilizing more tools to finance their growth, to embed in their ongoing operations. And so this area, which has largely been outside of access for the retail investor, is now coming into a more accessible place. And that's driven by institutional adoption of these varying financing strategies, whether it's financing growth through private equity investment or private debt investment, whether it's secured asset-based lending. All of these fit under the alternative umbrella. All have been investment options for institutional investors out there. And as institutional adoption has increased over the last several years, the exposure and the ability for the retail and the household investor has also gone up. And I think there's just been a wider adoption, wider comfort level of the idea that, yes, we can integrate alternatives. There's a track record. There's the understanding of what they are, how they behave. And so therefore, it can make sense to hold them inside client portfolios alongside the broader core portfolios. Finally, just to touch on point 5, the investor education and the world of information out there when it comes to these type of investments, that has significantly increased over time. It's really a nice experience when clients come to us and say, hey, I heard about, this private equity investment or this cryptocurrency or whatever it might be, is that a good thing? Can it fit in our portfolios? What is it? So fielding these types of questions is really proof that our clients are coming to us more and more informed. And it makes the adoption of alternative investments in client portfolios a lot better, a lot more successful when clients have an understanding, I think, of reasonably what the investments are, how they fit into their own portfolios, and why they're there. Okay, so what's going on in this busy chart? So it spans 80 years, and it is mapping out the relationship between two asset classes, stocks and bonds. Those are the two big ones out there. Left side, you're looking at the correlation in percentage terms. So we're going 40%, 0.4, all the way to 0.8. You can see that orange line going across, which indicates that in the first 2/3 of that chart, stocks and bonds have a somewhat positive correlation, meaning stocks and bonds tend to move together as the financial markets ebb and flow. Then there's a period between about 2020 and about 2025 where the correlations are negative, meaning if stocks are performing well, an asset class like bonds might not be performing as well or might be performing negatively at the time. Interestingly, that's actually a good thing for portfolio managers. It affords us an additional tool, an additional flexibility and options to rebalance and reallocate our client portfolios. It sounds like it's a weird problem to have if everything is going up in value at the same time or down in value at the same time. But the problem with that is that you don't have really any alternatives, or you have fewer alternatives. If everything's really expensive, well, then where do you reallocate to? If everything's really cheap and temporarily underpriced, then you have fewer options when you don't have a wider dispersion. So we've actually seen the last 20 years as being quite a good period. In the past sort of 3 to 4 years, we've noticed a return of this positive correlation between stocks and bonds. And again, this is another way that alternative investments can fit into a portfolio, and that it provides us an asset class which has a low or sometimes negative correlation to everything else going on in the portfolio. It in fact is an additional tool that we can use. Additional diversification and diversification which provides a positive financial return and a return that's not connected to our clients' core portfolios. And that's a really important point about alternative investments, is that there is a minimal and sometimes negative correlation with the balance of the portfolio, and that's a really good thing. Visually, here's what client portfolios can look like without assigning any specific percentages to the asset classes. The left side, you're seeing the classic 60-40 portfolio, 60% equities, 40% fixed income. Sometimes it's a little bit higher or lower than that, but that's what people regard in our industry as the balanced portfolio, the classic 60-40. When you add in alternatives, you can see on the right side, we're looking to take a little portion off of each side and include an allocation towards the alternative investment universe. And so that gray piece can be a singular fund. It could be a few different funds. But again, the point being to include a financial asset inside the portfolio with both positive return and a modest or negative correlation to the balance of the portfolio. And so while it might not seem obvious what that does, on the next slide, we can see, well, what is the expected return as an example for a classical 60-40 portfolio? And this is based on research done by JP Morgan for a specific subset of client portfolios, where you've got an annualized return over this reference period of about 8.7%, volatility 9.7%. Higher the volatility, meaning the higher the variability, the greater the ups and downs of the overall portfolio. 8.7% return, 9.7% volatility. If we were to back test that and look at the inclusion of alternatives, what happens? And in this example, we use a reduction of equities to 40%, 30% fixed, 30% alternatives. Now, that's not going to be everyone's allocation to alternatives, but this is just the example case. You can see there's actually a modest improvement to the return and a reduction in volatility. And that's kind of a thing that usually doesn't happen in the investment world. Usually, higher expected returns are accompanied by higher volatility. This is the huge benefit with alternatives. You get to have the same or better financial returns with the expectation that the overall ups and downs of your portfolio will not be as extreme. And so finally, when we actually, I've got one more, and then I'll hop over to you, James. And then finally, I was going to mention the growth of the impact market has been quite substantial over the last several years. So 21% over the last 7 years. And James will go into more detail on what's driving that and the different options there.
Great. Thanks, Darryl. Yeah, so impact investing, how does it fit within the alternative space? Darryl touched on earlier the Impact Investment Council and the work we're doing there. So definitely something to chat with your portfolio manager about if you're interested. Really, the impact investing space, we've seen a lot of growth since 2018 to 2023, which is what we have the data on. It's more than 3x in size with a 21% annual growth rate, as Darryl touched on there. This is according to the Global Impact Investor Network, GIN, as it's referred to. And of those investors, 73% of them are focused on private markets, whereas only 6% are focused on public markets. So it's really something that the industry is seen as the opportunity for impact investing and really driving change with these smaller firms and supporting them. So private equity itself within this space was the second largest grower at 32% per year. And it's also something that investors aren't seeing like reduced returns on. I think that's a common discussion between ESG impact and traditional non-impact investing is, do you take concessionary returns? But a lot of them, and what we're seeing is, no, we continue to invest with similar targets. So going further into that and the Impact Investment Council, where do alternatives meet impact? For us, we've been doing the Impact Investment Council since 2017, and it's our most impact-focused offering at Genus. It allows clients to be fully customized in a set of impacts, which can span a multitude of different goals and values and wishes. So something that kind of fits within those examples, to Darryl's points earlier in terms of private credit and debt within that, or venture capital, private equity, or a wide variety of things. So in the bottom of this slide here, you can see we have impact venture capital, which could be climate tech, early stage investing, or it could be healthcare investing, and a wide variety within that focused on companies that are highly scalable. So it's higher risk, higher return in that you're taking an early risk within a company, but it really could be something that provides significant upside and impact through that growth. Or we could look at impact bonds, where we're looking to finance projects that support affordable housing or community-based solutions to renewable energy production or community gardens. We have a wide variety of offerings that we see in Canada, and the Impact Investment Council has a focus in Canada. So it really allows clients to find companies in their backyard that really speak to them and can drive change and support the issues that we're facing, whether that's the affordability crisis, supporting affordable housing could be an investment opportunity, or you're looking to reduce carbon emissions, then you can look at climate tech solutions within that. Or you want to support women-led organizations and smaller grassroots companies, then microcredit financing can fit within that as well. So there's a wide variety of offerings that are allowed within the alternative space and what we find in the Impact Investment Council. Now, within that, there is the requirement of figuring out how that impact is made. So This chart has a lot of information in it, but for us at Genus, what we know from the experiences we have is in order to generate that impact that we're looking for, we have to make sure that it's measured. What gets measured gets managed, and with this, we work closely with a lot of these alternative fund managers to support them with data collection, implementation, and reporting as well to make sure we know that the underlying investments are in fact working towards something. So one way we like to share that, and this comes directly from our impact report. So if you're curious, you can find that on our website and see the impact that Genus as a firm is creating, and also some of the alternative investments that we have and the impact they're creating there. But within that, UN SDGs is a great way to share that information. So this chart tells us the overall alignment of investments, how well they're working towards a specific UN SDG, and how the underlying portfolio itself is reaching those targets and goals that were outlined by the United Nations, and targets that they're hoping to hit by 2030. So a lot of work to be done, but this investing allows for more scale. So within UN SDG 11, we see sustainable cities and communities and how they're able to invest in organizations that are working on affordable housing, low carbon housing, community-based solutions, and EV charging, a wide variety of solutions to significant problems that we might have. We also look at responsible consumption and production, decent work, and then economic growth. And the list goes on. So there really is kind of no end to the impacts that we can create in this space, and really allows clients access to those impacts there. So now going into a specific example, rather than speaking on the high level, what are some of these investing looking like? And what are some of the impacts that they're creating? So one that we really like is Raven Indigenous Capital Partners. They're an organization Raven Indigenous Outcomes Fund. So they're an organization based in Canada that focuses on outcomes financing, which means that return is measured by the outcomes, by the impact created, where Raven's focused on CO2 emissions reduction, energy efficiency, type 2 diabetes reduction within Indigenous communities. So their first investment that they've completed was in Manitoba in the Fisher River Cree Nation and the Peguis First Nation, where they went in to provide a community-driven solution where government programs were slow to act, and Raven was able to come in with a $5.1 million investment to support the development of geothermal systems in the communities and upgrading of homes to be more energy efficient and achieve better kind of operational efficiencies within the homes themselves. So within the investment, they were able to achieve a $7.6 million outcomes value, which is calculated by a third party through best practices to assess how much value is created in that reduced harm to the environment or improved energy costs for the community, a whole swath of things. And then the government comes in and pays those outcomes to Raven so that this private capital is able to receive a return and reinvest that capital into another project. So it's really the private sector coming in, being that first capital to make sure this works and is able to be something successful, and then also something that's scalable that the government can support and finance, but not have to take as much risk, and also improves efficiency across that span too. So it's one of those examples of how the private sector is supporting the public sector to achieve better outcomes, and we see a lot of similar investment structures in the Impact Investment Council. Now to go into a second example, this is a group, Heartwood Trust, that is partnering with one of the largest collections of urban infill land in Canada. So that means They have over 300 sites within urban centers within Canada that allows them to get access to opportunities to develop new housing within those communities. So an example we selected was the investment they've made in Mississauga. So Heartwood brings seasoned financiers and developers from the private sector and has developed a fund that looks to invest in housing that addresses core housing need. So core housing need itself is a government metric set out by the government to address affordability, accessibility, and also adequate housing. So what does that mean? It means that they're developing housing that is below market rent, low carbon, and has enough space for families to live and a larger community to be developed within those spaces. So this example is focused on 250 low carbon rental homes. So every development they have is fossil fuel free in the development, so zero carbon emissions on site. And then also the housing itself is energy efficiency focused, LEED certified where possible, and focused on also on-site renewable power generation. They also will be installing EV charging systems and will have 78 units at below market rent. So Heartwood itself, we see working within helping to solve the climate crisis in that they're building facilities at zero to low carbon. And they're also looking at the affordability crisis, which is something that Ontario is facing and lots of Canadian regions where they're able to provide below market rent housing and still generate a return that's adequate for an investor, whether that's a high net worth individual or a foundation. So it's really, really something that allows us to find these opportunities for clients and invest in unique ways to generate a return for whatever goal the client might have, but also align with their values that way. Now, there's a whole swath of other options out there and other offerings. None of these are specific recommendations, but I recommend you chat with your portfolio manager if you're interested. The kind of buckets we like to put these in are four: social justice, caring for climate, caring for Indigenous people, and rural communities development. And all of these span that venture capital and private equity space, impact bonds, real estate, infrastructure development, and community-based projects. So a few examples to pull from here, first being Misfit Ventures. It's a venture capital fund focused on supporting LGBTQ plus founders. So a group that is underrepresented in venture capital, and really something that the founders of this fund felt that there was a need within the industry to support these founders and really lend them a voice and capital to grow these organizations. The second one in the bottom left is Seven Generations Fund. Seven Generations is part of the Hungerford Properties family of funds, and it's 100% Indigenous owned. So what they're able to do is they're able to leverage their understanding and their network within Indigenous communities to build real estate on reserve with a focus on capacity building within those Indigenous communities, as well as maintaining the community that is there, while also focusing on providing economic returns and impact within that. And all of their housing is focused on low carbon as well. So it's a wide variety of impacts there, but something that also allows for better efficiencies in the real estate development process as well, working with councils rather than full government bureaucracy. They're able to operate quicker within that. So there's a whole variety here. And if you're curious about any of these, feel free to reach out to your portfolio manager on that. So now some important kind of implications within private alternatives that as an investor you should know in order to kind of have a proper understanding of how you can get involved in these investments and what are some of the constraints within that. So, as an investor in Canada, we fit within a series of Security Commission rules. So, with the risks involved with alternatives, there is some constraints in clients' ability to invest. And that comes down to two different tests. The first one is an income test, which means you have to have $200,000 in annual income over the past 2 years as an individual, or as a couple over 300,000 over the last 2 years. The second is a net worth test. So assets, whether that's a specific investment portfolio, such as the one you might have at Genus, with a million plus in financial assets in it, or a larger investment kind of asset base where that is at 5 million, which includes real estate. So if you have a large primary home, then that can be calculated in that. You can fit within either of these buckets, but the main reason behind that is because there's more illiquidity in private alternative investments, which I'll touch on in a moment here. And there's also that higher risk. So it's really about making sure clients are in a healthy financial situation to be able to invest this capital and still have access to the opportunities without taking on too much risk that might leave them in a financially challenging position later on. So, touching on the illiquidity side of things, years 0 through 3 of an investment in private equity will be spent locked up looking at investments. Years 4 through 7 will be looking at growing those companies that they've now invested in. Years 8 through 10 will be spent returning that capital, so selling those investments and harvesting the returns, and then returning that to the investor. And if needed, they could take an additional 2 more years, up to 12 years of investment, where clients don't have access to that capital. So those 12 years invested, a lot can happen in those 12 years. So that is why that accredited status is required. So again, would recommend you chat with your portfolio manager on any of those aspects to see if this could be a fit in your portfolio.
And then, James, I think it's worth noting that some of the alternative investments within some of the IFC investments have liquidity profiles that are a little bit more favorable in that they are fixed income. They can have maturity dates of 1 to 3 to 5 years. And within that time span, you're actually receiving interest and coupon payments back. So it doesn't have to be this side of the spectrum where money out the door and you don't necessarily see it for 5 to 7 years or so plus, that long lockup period. It could be the case that you can have a significant impact, allocate those funds, and be receiving cash flow immediately. That's not for every single IIC investment in there, but there are a handful that are debt-like and provide cash flow on a yearly basis. So you do have some liquidity in the meantime.
Exactly. Yeah. Yeah. This is kind of the longest case that we'll have. And even then you're also returning capital in that harvest period and in that growth period. So yeah, it's not all 12 years or 10 years. Now kind of going into how Genus assesses these alternative investments in our process there under the Impact Investment Council. It's a process that we've developed and continue to develop over the last 7-8 years, and it takes kind of two factors: the internal research and then the external research. So within the internal research itself, we're looking at how a specific investment is looking to generate return. So venture capital, investing in companies; debt, investing in projects and growing those projects, and a whole swath of offerings there. We also look at the finance and operations of the company. How well are they set up to support investors and manage all of these investments and continue to grow over time and continue to operate in a successful way? The impact assessment is a key for us. We want to see that the organization has investments that work in tandem, and also a leadership team that really believes in impact and generating that impact. And I think it's something that we've been able to do well, in that we can locate these founders and like-minded individuals because of Genus's reach since starting the Impact Investment Council, and it really allows us to find that community as well. And then the last one is governance. How well are they set up to kind of have the leadership team managed by an external set of advisors, a board of directors that really kind of lends themselves well to the environment that this organization is looking to invest in, so that they're able to manage the risk well and also set it up for success longer term and continue to grow the organization at over time. Then looking into the external, how well does the model fit within what we're currently seeing as investors? Being at Genus, we're able to have a global kind of mindset through the investments that we have on the public side, and we can bring that thought leadership into these investments and look at how industries are moving, where are we seeing opportunity, where are we seeing risks within this, where are we seeing threats to their underlying business model or impacts over time. Then the last aspect is really getting to understand the partners, the leaders of these organizations. And that's through reference checks of chatting with other investors, chatting with people within the industry that have known them for a long time, looking at their auditors' processes and all of these things. And then we also do background and credit checks on each of the key decision makers. And then lastly, we go in to legal review. So we have our legal team look at all of the investment documentation to make sure that our clients are set up to succeed if there are issues that come up, and also ways to mitigate those risks as well. And we bring that feedback to those investors as well. So it's a full spectrum analysis that we do on each of these investments before we go to final approval, and then the portfolio manager will decide how well does that fit within a client's portfolio. So that's it for me. I'll pass it back to you, Darryl.
Cool. Thank you so much, James. So we've got a lot. That was a lot of information. I appreciate you laying out what is an area of our business that some of our clients are familiar with, but definitely not a lot of clients have exposure to the Impact Investment Council. So if any of those options sound like they could fit within your impact goals, definitely reach out to your portfolio manager. So to summarize, looking at the different options that we've got for clients at Genus, it's a fantastic range, an amazing spectrum of options out there to accomplish both your financial objectives and fit within your values standpoint. Expanding the alternatives that we offer at Genus is something that we continue to do. The commercial mortgage fund has been a product offering that we've had. The successful launch of our commodity fund was just completed. We'll continue to look at our expertise when it comes to specifically impact investing and how that can fit into our clients, all of our clients' portfolios, and what options we can provide for investment solutions there. And finally, when we're looking at portfolios from a holistic standpoint, we really want to ensure that that we are putting your interests first, and that we are looking at ways to both maximize the returns that you are generating in your portfolio and the amount of impact that you are contributing. So again, here's that product spectrum of the things, of the different investment solutions that we offer at Genus. With that, we can bring it to some Q&A. We've got about 10 to 15 minutes before we finally wrap up. So if you've got any questions, please feel free to put them in the chat. We'll just take a few minutes for you to gather your thoughts and throw some questions in there. And so the first one I can see for Cassandra, the answer is potentially. And so that would be one to have a follow-up question or follow-up discussion with your Genus portfolio manager. I think while we're waiting on extra questions to come up, James, like in putting together the slides, the information. We've been talking about alternatives for a number of years. Is there anything from a high level that there was my phone. Anything from a high level that stands out to you as either surprising or information that you didn't expect to see when kind of digging up the research?
Yeah, I think for me that kind of initial slide I was touching on, around 73% of impact investors being primarily focused on private markets. I think that sounded higher than I anticipated. But I think something that we at Genus understand, in that, like, through our Impact Investment Council, a lot of impact investors that we find are investing that way, and less are discussing the public equities side of things.
Right.
Just because it's a challenging space to locate those investment opportunities, in terms of the public markets, and there's less fund managers that do it, like us at Genus, obviously, and a few others in Canada, but something that's not widely seen,
Yeah.
at least.
Yeah.
Yeah.
In terms of deals, there's that slide that we had earlier on. I should say deals, but investment options. Let's scroll back for a second. There's quite a number on here. I don't think this is the exhaustive list, but this list, I think it's helpful context for the audience to know it's dynamic. So there are investment options that are available at this time. Typically, with a lot of these funds, they'll have a sort of an objective, go through a period where they're raising capital. They may not be raising capital indefinitely. Many times there are cutoff points where they are raising money, they get their checks, and then they go off and engage in the different projects that they've got. So there's this list here, but we'll continue to have a number of different investment options, investment funds that the team at Genus does an amazing job at screening for and doing the due diligence on, and ensuring those funds from a due diligence standpoint that they all check out. We need to make sure that when we're recommending client money go into any of these investment options out there, that the investment teams that we're working with, they are properly staffed, they've got the requisite people, knowledge base, the requisite experience to handle investment in these extra areas. So I think this is really neat to see, sort of how this list evolves over time. There are definitely a few funds that we are sort of seeing and are going through due diligence, and will hopefully be available to clients later on in the year and then earlier into the next year.
Mm-hmm.
Okay. So,
See some more questions coming through now.
okay, so let's
Yeah.
go through them. From Mary Lou, are we seeing more regenerative ag offerings in the impact space? My observation is casually yes, and I think James, you would probably say the same.
Yeah, I think we see more and more of a need for it, and also that kind of investment case has been made by some kind of first movers in the space, where regenerative agriculture investing is showing ROI, and it is showing an opportunity to create value not only for the financial side but also for an impact side, where there's healthier food being produced, and kind of going further than the organic movement. How well can you kind of support the ecosystem around where you're farming, where you're producing cattle, and how does the full ecosystem operate together? I think there's a better understanding there too. So definitely seeing a lot more offerings within that space. So within this table here itself, Invest Eco is focused on that, and Bloom Local Food Fund also looking at aspects of that.
Question from Susan. Are we suggesting that investors work with their own investment organization as well as Genus? The short answer is yes. There can be investment options that you could have with your existing portfolio manager or investment manager if they're not Genus. The longer answer is it's unlikely, I think James and I would agree on this, that the level of impact in the investment options are going to come anywhere near what we have available through the IC at Genus. It's a very specialized area for a number of firms. They are barely getting into the world of impact investing. Their definition of what impact is, we've seen many times over and over, can be significantly different. It may not even be sufficient for you as the investor. So those are parts of the conversation to have. I think those are things to think about before we have those conversations. What does impact mean to you? It may mean something different from your wealth manager. I think here, James and I have laid out what the options are when in terms of what Genus thinks of as impact. And so, yeah, I'm always excited to look at the list because it's very clear to me, when we talk about impact investing, what the options are, where the money is going, where that capital is going, and what tangible effects they can have. How is the alternatives fund balance with respect to risk, venture capital through debt? We don't have, Sucheta, we don't have an alternatives fund at this time per se set up as a blanket fund. There's the commercial. We have a fund that invests in commercial mortgages. We have a recently launched commodities fund. And in the future, if there is going to be a fund that offers a different degree of access for impact investing, one of their criteria, I'm sure, would be that there would be a spectrum of different options when it comes to private debt, private equity, and the liquidity profile of any of those underlying options to provide some amount of liquidity for clients that's better than any of the individual offerings. But that is all part of an evolving discussion and research that we continue to do.
Yeah, and within kind of each client's portfolio, that fully customized aspect, it really is what's speaking to them, but then the portfolio manager's mindset of how do we manage risk properly? How does it fit within what our targets are? What's the acceptable amount of risk? What's the investment time horizon? All these aspects we bring together to have a kind of full understanding for a client that works within their investment policy statement and their goals and their values. So it really is kind of case by case with the Impact Investment Council.
Yeah. And then, James, can you comment Eric's question on the quantitative factors that we use to evaluate impact investments? That's a really good one.
Yeah, great question, Eric. I think kind of starting with the impact angle, it really spans a lot of different aspects, which I kind of touched on throughout the presentation, but kind of like specific ones, CO2 emissions reduction, clean water produced, waste diverted, affordable housing units generated, a full list of kind of quantitative numbers on the impact side to make sure that we're kind of hitting those overall goals within that. But then within the organization itself, we look at their track record, their annual returns that we see, the fund level returns, the amount of risk that we are able to calculate through that as well. So the standard deviation kind of is a typical one. The leadership team's experience, years involved, and kind of developing factors around that, and also expertise in the space within that too. So it's a kind of wide variety of things, but I think probably one of the keys within the private side is making quantitative impact measurement something that's feasible for these smaller companies. It might be a team of 5 people that's running a company that is focused on generating revenue, developing a product, and then we tack on this kind of impact angle, which is important to understanding the company and what they're able to achieve, but it's also quite onerous. So it's finding a happy medium where they're able to track something to best practices, but not to the point that they need to hire 1 or 2 people to be able to track this, which could hurt their business's ability to grow and scale. So it's kind of that fine balance that we need to find, and that's something that we've been able to work with these different fund managers on locating and working with industry experts to better understand that.
Yeah. And finally, from Paul, what would we recommend for people who want to do impact investing but don't have the annual income limits? We would require a couple of options. Number one, stay tuned to what we're working on at Genus. This is an area that we hope to to provide additional solutions on, and making impact investing even more accessible through the expertise of the Impact Investment Council. And then depending on which province that you're in, there are nonprofit organizations out there that issue community bonds. There is equity crowdfunding. That's not a type of investment option that we have in-house at Genus, but it's one that exists out there. So again, it's a little bit challenging to find those different types of organizations that are receiving capital in additional ways. But depending on where you are, those can be fantastic options that I personally have clients who have small allocations in those areas alongside their Genus portfolios. But again, when it comes to impact investing and making that more accessible, more inclusive for our clients, this is an area that we continue to work on through the expertise of our IAC. Okay. And well, we've gone through the slides there. Q&A. So in terms of contact information, this is where you can reach me if you've got any additional questions. Both myself and James, our contact information is in the chat. That brings us to about all the time that we've got for today. If there are questions that we didn't get to, I think we got to all of them. But if you have any questions following this webinar, definitely feel free to reach out. We're always here to answer and provide some helpful insight and solutions for you. And I want to just express my thanks to everyone for taking the time today to be with us and go through like a ton of information. We really loaded up a lot of knowledge, and hopefully it wasn't too much. But again, if you have any questions, please let me know. James, I appreciate your expertise in this. It's a really exciting area, and there are, I think, a few people who know it as well as you. Whoop, excuse me, just knocked over right. Know it as well as you and explain it as well as you do.
Thanks, Joe. Thanks, everyone, for joining.
We'd also like to invite you to our next webinar. It's focused on what happens when relationships break down and what does that mean for your assets. And that's going to feature our own Grant Conroy and Eli Walker. A recording of today's webinar will be provided to you through email. So it will also be on our website in the next few days if you want to revisit. And please do share it with family or friends. And that email will also include a link to any resources that we've mentioned. Please do stick around for a few more minutes. As soon as the webinar is over, you'll be redirected to a survey, and we'd love to know your thoughts and feedback. And that's it for us. Again, appreciate you joining us. Enjoy the rest of the day. We'll see you next month.